What do you think the inevitable question, maybe, but what do you think the impact of Brexit might have on the private equity market?
So impact on private equity directly will be, I think there's money that we used to put the EU in a bucket. So the people who invest in our funds would have a strategy to invest in the EU. Now that money has to decide EU or Britain. So I actually think there will be money sort of washing into UK private equity funds. I think it's probably a bit positive for funds that aren't reliant on the EIF. The European Investment Fund used to sort of seed quite a lot of PE funds. So I think that would be a challenge for some, but not I suspect not many on this call. I think the real issue is just and I don't want to make it sort of too political, but the disaster that was Brexit and the disaster of the lack of planning is coming home to bear. Financial services industry is sort of 20% of our GDP, and they announced a deal that didn't include the financial services sector. So there's now, we recently invested in a commodity broker who sat there saying, we actually don't know what we can and can't do from a regulatory point of view. So I think that is going to feed through to the economy. I don't know if anybody on the call has got the misfortune of trying to transport products in and out of Europe right now, because that's an absolute disaster. We've seen mass migration out of the UK because of COVID. I think London lost a couple of 100,000 people net. They've all gone back to their home countries in Eastern Europe. So maybe the Brexiteers have got a bit of their wish, but we will be dealing with the wage inflation, certainly at that lower end of that, for quite a long time. So I think actually Brexit it was always going to be bad, and it's going to be even worse because we're trying to deal with it sort of coming through COVID. So I guess my only view, and you probably guessed my view on what we should and shouldn't have done, but it's turning into the disaster that it was always going to be, and we'll just have to live with that.
I see you're not sitting on the fence there, Jamie.
Oh, I was. That counts as sitting on the fence.
Yeah, I believe that. And Luke, would you like to add anything to that?
Yeah, I think it's one of those. It's going to be incredibly difficult to say and to unpick from the impacts of everything else that's going on. But everything else that's going on is making it a lot harder compared to if we were in a better place in terms of economic cycle and so on. I think there are those funds that are much more focused on the large cap transactions who probably have a different set of considerations going on, and none of us on this call sort of fall into that bucket. In terms of our businesses, it's quite bifurcated. There'll be technology businesses, SaaS businesses. The next logical step is the US, and we don't anticipate there'll be much impact at all. There'll be others that do move physical goods and that trade more with Europe. And yeah, as Jamie says, it's really difficult, and it's seat of the pants stuff, figuring things out at the moment. A specific I'll pick up, and Jamie sort of touched on it, but it is about staff. In the wake of the Brexit referendum, we saw real issues, particularly with some lower skilled European labour that some of our businesses used. I think we're going to see that compounded now for all types of staff, or we may see it compounded. We're finding out. But so that access to staff who previously might have, there's a much more fluid European pool. That's going to be something we're watching for with our companies.
Thanks, Luke. And last question before I go to questions that have been put by people listening in and attending. And thanks very much for those. I'll come on to them in a few minutes. James, what sort of liquidity do the lower and mid-market funds have to invest, do you think, during the next couple of years? And
yeah. As in a couple of people, there's a lot of dry powder within PE in the lower mid market, and there's a lot of funds that have been raised over the last 12-18 months who are going to be looking to deploy and looking to get those first couple of important assets in their funds and motor on from there. So you've got a little bit of tail wagging the dog from that perspective, but as has been mentioned a couple of times, this is an asset class where returns can be ahead of other asset classes, and so it's still attracted to people from both an equity perspective in PE funds and a debt perspective from these alternative lenders. So I can't see a slowdown in the amount of liquidity in the market in the short term, at least. If anything, I think there'll be an increase, particularly coming out the back of this.
Thanks for that. And Rupert, sort of finally, would you like to add anything to that?
Yeah, I think that we're all saying the same on this theme, that there's a lot of money out there. It is going to be chasing deployment. There's then a little bit of a race as to can it get away fast and be used up before more can raise. I'd be saying, I think everyone's saying no, it's going to be a challenge actually, because the sort of people are going to be picky on quality, and the quality won't universally be there. So I suspect we're going to be in this scenario where there's more money than there is good deal flow, probably for the sort of 1 to 2 year time horizon that you asked for. I can't see at that point people are not continuing to raise and that there's big pools of money, but that'll be when it potentially bites, if those high valuations have made returns stagnant, and therefore at that point people struggle to raise and the pool diminishes. But you've then got to be looking at that as in, if PE isn't raising money, where is it going? And it would be an odd outcome, I think, that led to some other asset class sort of taking back that allocation. If you remember that PE is still only sort of single percentage points of global asset allocation, and it's been going up from sort of 2 to 4, and that's led to this enormous slew of money compared to going into more sort of traditional liquid classes. So it's not going to go to nil.
Thanks, Rupert, for that, and thanks everyone. That's a really interesting and informative spread of views in a number of subjects there. And so I'll just move on to some questions as we go to the latter part of this webinar from the attendees. And Jonathan has asked, how concerned are you about future tax policy? Is that a factor around timing and choice of investment, or accepted as uncontrollable? Does anyone want to venture an opinion on that?
I'm more than happy. Definitely. I mean, it is uncontrollable at the end of the day. It's one of those factors that's out of our hands. I mean, what we're seeing currently, or what I have seen over the last couple of months, is a lot of deals being brought to market because of this imminent CGT change, which people are expecting in April, but there's a widespread view that might be deferred, and that's driving a good amount of deal flow. And advisors are being very open and honest and saying, "This is happening. The guys want to sell before then." And that's, if I was selling, I wouldn't particularly want people to be saying that about my business, because there's an air of desperation about it, and therefore there might be some value in there. But it's the reality of the situation. And COVID has brought to the fore the fact that some people don't want to be operating anymore, and they don't want to wait 5 years for it to recover and get to where we were, back in 2007, when they were waiting that same period of time. So tax will change. There's very little we can do about it individually. We can lobby against it as groups, but they're going to do what they're going to do at the end of the day. The thing to do is to manage around it and be as sensible as you can be, and just plan for it.
Thanks for that, James. And maybe elements of that touched on a question that Stuart has asked. As a small business owner dealing with the pressures of COVID, is now a good time to secure private equity investment? Would anyone like to comment on that?
I think.
Yeah. Go on, Rupert. Yeah.
Well, what I'd say is, from what we've been saying around the room, it's if people are willing to transact with you, they're probably willing to do it at a reasonably high value. So I think it's not a bad time at all, actually, to take on private investment, and particularly because if we look at this outlook from now that's sort of been traced out by the various conversations that we've had, it's going to be, there's a lot of opportunity, but it's a difficult couple of years, and that is not a bad time to be the person with all the cash. Really able to sort of, if you've got a clear plan and kind of a view of why, if you had quite a bit of money, you could do something with it that would capitalize on this opportunity, then I think it's actually probably great time to raise.
Thanks, Rupert.
Sorry, got you off.
And Jamie, did you want to add anything to that, or?
I agree.
Okay, that's good. That's always helpful to anyone listening, if at least two people agree. Sabine has asked quite a specific question. I don't know if you're able to comment on this, anyone, but what is the trend and appetite in investing into pre-revenue companies currently? And she's mentioned, for instance, companies that have developed a variety of products that are ready to be launched in the AI autonomous robotics market and in need of capital to kick off going from R&D development, done pilots, and now ready to go commercial. I don't know if anyone feels they want to try and answer that one.
So for YFM, I mean, we like that space, but we don't invest in pre-revenue businesses. So for us, we need to see a minimum of $1 million of revenue before we can invest. And unless I think from what Rupert said earlier, that you'd sort of be similar stage to us. I think the UK, people talk about the funding gap in the UK, which has been a thing. Obviously, the banks put £1 billion or more into BGF to sort of fill the funding gap, which really just competed with an already quite competitive private equity market. So I think the funding gap is really that sort of pre-revenue startup, which is still reliant on angel networks, friends and family, unfortunately.
Thanks.
I see that changing.
Thanks, Jamie. And Nick has asked, wondering on your views about making minority investments versus controlling stakes.
I'll jump in there, Mark.
Thanks, Luke.
I think a lot of it, firstly, we'll have our particular sort of criteria, fund rules and tendencies and so on. So those of us with VCTs typically deploying growth capital funding, and they will be minority investments. MBO buyout funds will typically take majority stakes, or at the very least, very large minorities. So some of that won't be so much a choice around the businesses we find, but partly dictated by the funds we have and the investment situation. I think there's probably less distinction, though, than many people may expect from our points of view, in that, typically we're looking to back a team and to work constructively with that team. We will need certain protections, whether we're in a minority or a majority position, but equally, we typically wouldn't be looking to ever, be working against the wishes of the management team or anything. So sort of whether we're 51 or 49% doesn't particularly matter in terms of how, I can't speak for everyone, but I think everyone here would actually look to work with a portfolio company. It's dictated by a number of things, but I think it's not something we have particular views on, because it's just doesn't have the sort of impact people might expect.
Thanks, Luke. And a question from Donald, is COVID having a material impact on due diligence process, timescales and new deals? And have you noticed any regional differences on deals? Anyone like to comment on that?
I'll put a couple of comments and others can add. I think it's been difficult to do transactions quickly, but actually I don't think in our case that's particularly, it's not helped by the diligence having to be remote specifically. It's more about, I think everyone was hanging on to see, would we actually do a transaction without sort of meeting face to face, or not meeting face to face anything like as much as we'd sort of normally do. So that was sort of what we could wait a bit, and then we have now done, we're in that position, we've done transactions with people we have never met, although we've spent tens of hours on video calls with them. It's quite a weird place to be for an investor. We've all talked about it today, we're very close to the portfolio. So that sort of stretched things a little. Just on the regional point, it has made us think a bit more about the people we choose to work with, and if it's remote, it can be anyone, and therefore should we be looking afresh at regional DD providers? But that's still probably a thought rather than an acted upon piece of planning.
Yeah,
I'd agree. That piece, the interaction with management piece, and what you get from sitting in the same room as someone, and the little tells, subtle tells, and just building that rapport. I think Zoom calls make that very difficult. We're investing in a business at the moment that has factories in Asia, in Wuhan of all places, in China, which obviously we can't go and see, but we need to have a look around and make sure. So we do virtual tours and stuff like that. So there are ways around it. It's suboptimal, if I'm completely honest. But you work with what you can, and if it's a good business, you'll work out a way to get yourself comfortable. And on the, the FDD is the most obvious area where you've had the scenario planning for COVID in the forecast. You've got the debt stack for COVID in the past, and you're trying to strip out some of the impact of some of the furlough schemes, etc., that the business has had. So there's a little bit of unpicking, and it's a bit fiddly, but ultimately you can get to the right conclusion. But I do think it would add 1 or 2 weeks to people's diligence processes, just because it's a change and it's more difficult to get yourself as comfortable as you would pre-COVID.
If I can pick up on the regional piece,
yeah.
I think we've definitely seen differences in different regions. I think there are different ecosystems in all of the regions. We have to manage the Midlands Engine Fund and Northern Powerhouse and some other regionally focused funds, and they all have different competitors and different dynamics. I think oddly, at the start of it all, having opened up regional offices, I think, well, of course, everyone's doing it by team calls, so it doesn't make such a difference being physically close to any businesses or anything. But actually, I think something else is it's incredibly hard to network, and people obviously work best with people that they know. So actually, the benefits of having those regional networks and so on has been really impactful during this time. Even if you're having a team's call amongst people who are all sat within a few square miles of each other. And I think obviously different regions have very different sector emphases and challenges and workforces and that sort of thing. So short answer to the question is yes, we've absolutely seen differences regionally, and a need to sort of pay a bit of attention to what those differences are regionally, rather than treat everything with a broad brush.
Thanks, Luke. I'll try and get another couple of questions in before we close. Excuse me. Robert's asked an interesting question. I don't know how you'll all feel about this one, but what is the most difficult stage of the private equity investment process? Selection of the right companies, growth of the invested assets, or timing of the exit?
Yeah, it's interesting. It depends which one you're doing at that moment in time. Because I guess the one bit that's not on there that we think probably the hardest is winning the transaction. I think there's been a real power shift. Well, yeah, so I've been doing this for 10 years. There's been a real power shift, maybe before that 10 years of private equity used to walk around, dominated by 3i, could pick and choose what it did. Whereas now you've got 4 of us on here regularly competing, and that's a tiny fraction of the market. So I think the hardest thing is meeting teams and convincing them that you're the right partner. It's sort of gone are the days where the first meeting is all about private equity interrogating management, and management desperately trying to get them to want to do the deal. The shift is on the other foot. So I'd put that as the hardest thing to do, is getting the right to choose.
Yeah, no, very interesting. I don't know, does anyone else want to comment on that, or shall I'll move on. I've got, I think, a very specific industry question. So I don't know if anyone's knows a great deal about the horticultural industry, but Vicky's asked, is there any specific view on the attractiveness of UK horticultural as an industry for investment?
Yeah, so do you remember, Luke, we competed on that asset, didn't we, that dug holes? Do you remember? The hole digging.
We did. Yeah, we did. Out in the Cotswolds.
We did. No,
yeah.
And then neither of us did it. So
neither of us. It's what you're saying, Jamie. The hardest bit's the winning of it. Yeah. Yeah.
I think the reality, so for YFM, I mean, what does horticulture mean? So the supply chain to the horticulture industry is really attractive. And there's lots of that gets done. In terms of actually investing in horticulture, I think the time horizons are different for most private equity funds. I mean, without wanting to sort of state the obvious, those things take time to grow, which are normally outside the normal time horizons. I mean, we've looked at some great stuff around vertical farming, accelerated farming and all of that stuff. And we just sort of look at it and go, actually, we're sort of investing for a 5 to 7 year horizon. These things are 10, 20 year horizons. So I'm, never say never, but in terms of actually investing in a horticultural business, probably a bit hard because of timing differences.
Okay, adjacent, we've got a garden centre business in our portfolio, a really fantastic one called Roseborn, who's run by a lady called Carol Paris, very impressive, who was the chair of the British Horticultural Society. So that's just, so we've got it completely stitched up, and then strong bullish.
Good to know. Thanks very much, everyone. And for people that put questions, sorry we didn't get around to more of them, but we're coming to a close. And I'd really like to thank Rupert, James, Jamie and Luke for making this a really good session. I'd like to thank all of you for attending and hope you got something out of it. Please do let us know any feedback on today, your thoughts. I'll email you all a link to a post I'll put on LinkedIn where you can comment if you wish. Hopefully you'll interact on something one way or another with FD Recruit in due course. We have ongoing webinars and Patsy in one of those. Have a great day. I do have a feeling the recording might have missed a beat when my internet went down, but there you go. So very many thanks everyone, and we'll be in touch soon. Thank you.